Everyone, and welcome to today's market snapshot. My name's Craig Erlam, senior market analyst at OANDA. Now, it's been quite an interesting day in the markets. There hasn't been too much in the way of economic data. We did get the RBA rate decision overnight. That's the Reserve Bank of Australia. They kept interest rates unchanged at 1.5%. The rhetoric from the central bank was largely in line with what it has been previously, despite the fact that we do have a new RBA governor there. The one key difference here, which was taken as quite dovish from the RBA, was the points on the housing market. They didn't seem to be quite as concerned about the housing market anymore as they have been in the past. Now, I'm sure that could resurface going forward, but they did want to stress the fact that the growth in house prices has cooled a little bit recently, apart from in certain areas where we have continued to see quite a significant growth. But it does seem to be that this is an area that they're less concerned about. The importance of this is that this is seen as one of the things that's prevented them from cutting rates at a faster pace in the past. The fact that they're concerned that by cutting rates too fast, they're only going to exacerbate the house price, the issues in the housing market, and this has kind of held them back previously, I guess, and meant that interest rates have stayed higher than they otherwise would have been because either the economy was slowing down or inflation was too low. And the transition from the commodity boom was going slower than expected. So this was a bit of a slightly significant change in tone from the RBA. But for me, it doesn't suggest to me that they're necessarily willing or looking to cut rates in the short to medium term. I still think they are confident in the economy for now. That doesn't mean that in the next few months they may not change their mind. I think expectations here for the RBA do still remain quite mixed. So I don't think we should be too surprised by anything really in this circumstance. But for me, this one message alone doesn't change it too much. And as far as I'm concerned, I think the next meeting or two they may still hold off yet again unless the situation does deteriorate a little more. We did get the PMI, construction PMI, from the UK earlier on this morning. That far exceeded expectations, coming in at 52.3. It seems that particularly in the residential sector, or mostly in the residential sector, these firms are a little bit more optimistic because the near-term consequences of Brexit have been lesser than expected. I think it's worth noting here that since the vote itself, nothing has physically changed because the Article 50 hasn't been triggered, negotiations haven't begun, and therefore that period of uncertainty hasn't really hit home. It is worth noting that the pound's just hit a record. It just hit the lowest levels since 1985 today, since Theresa May confirmed that Article 50 will be triggered before the end of March, and Philip Hammond, the new Chancellor, has warned about the rocky road that lies ahead for the UK, that effectively suggesting that the economy is going to worsen, even if data in the near term has suggested otherwise. So I think this has largely been overlooked because of what's happened over the last couple of days with regards to these comments. And this again is something we're going to touch on in a sec. We do have a few charts lined up for you because I do think these better show what kind of a day it's been. Like I say, it's been quite a quiet day in terms of economic data. We do still have the API crude oil inventory data to come later on this evening, which should ensure that oil remains volatile as it has already today. The only other really noteworthy story has been from the Fed. We've got two Fed speeches today, one from Jeffrey Lacker and the other from Charles Evans, both of which are non-voting members of the FOMC. It's worth noting. But I just wanted to highlight a few of the comments which Jeffrey Lacker made earlier. One being that downward pressure on inflation from oil and the dollar has largely played out. So that is an indication that he believes, at least, that inflation is going to pick up in the coming quarters. He believes there's a strong case for raising the Fed funds rate, and also he would have dissented in September and stated that gradual rate hikes are needed. In his view, he actually said that the correct rate of interest right now should be around 1.5%. Now, again, it is worth noting that he's not a voting member of the FOMC, but it does just fall in line with the more hawkish rhetoric we are generally getting. And I think even the markets are now buying into the fact that we are likely to see a rate hike in December. Fed funds futures currently pricing in around 62%. Now, as I said, I want to show you a few charts here because I think this is the best way to display the kind of moves we are seeing today, because despite the fact that news flow has been a little bit slow, we have seen some very significant moves in the markets. And this was also one of the requests which we had in the comments section as well for more visuals. So thank you for your feedback, and I hope everyone, and I welcome any feedback from anyone, both positive and negative. These videos are meant to be as useful as possible, so any feedback is always more than welcome. The one chart here I want to show you is cable. We mentioned that they've dropped to a 31-year low against the dollar today. You can see the sell-off yesterday was on the back of Theresa May's comments. We went through this support around that 128.50, 129 level. Now this was the post-Brexit low around 127.96. That has been broken today, and it looks like we are going to see a close below there. We have found support around that 127.50 level, but with the pound now trading at 31-year lows, against the US dollar, it would suggest to me that even if we do get a retest of that in the near term, that will be the next resistance for me, that 127.96. But if that holds and we don't see a move back higher, or even if we do and the 128.65 comes into play as possible resistance, things are looking much more bearish for me now that we've seen that post-Brexit low broken at this stage, and I do think we could be headed back towards these kind of mid 120 range, back towards around the 125 levels in the coming weeks and months. Things have just taken a much more bearish turn for the worse, as far as I'm concerned, when it comes to the pound, and I think just the suggestion or the confirmation that Article 50 will be triggered from Theresa May has potentially triggered that. Maybe there was a little bit of hope previously that either it wouldn't be triggered or there'd be a second referendum, maybe an election, but the message certainly coming from Theresa May right now is that Article 50 is certainly going to be triggered, and it's going to be done by the end of March. Another very interesting chart today has been the moves in gold. We saw this sudden sharp sell-off in gold just around the time that the US was coming, the US trading day was starting, just before 1:30 in the UK. And we've talked about this these $1,300 level before being a key level of support, and it's not really clear at this stage exactly what it was that caused the break of that $1,300 level, but given how big a support level this was, the fact that we had this level broken meant that we did see a very sudden move back towards 1290 here. Clearly a number of stops sitting below that $1,300 level meant that we saw this move rapidly back towards 1290. We found support there around the 50% retracement here from these lows on the 30th of May to the 11th of July. We did find some support there, but that didn't really last long, and again we are seeing some downward pressure. It really does look to me like we are going to see a daily close now below the $1,300 level, and if we do, then things are looking a lot more bearish. I think we could be looking at a move back towards 1250 in the coming days and weeks. We may see a retest of that $1,300 in the meantime first, but another area I wanted to highlight is 1270 to 1280, because if we just look at the weekly chart, for example, here on gold, my bad actually, just let's stay on the daily. If we just zoom out on the daily chart here on gold, you can see that 1270-80s region has actually been a notable region of support and resistance throughout this move, even if it hasn't always proven to be necessarily a high or a low for the pair. It has been a key region of support or resistance, so this may provide temporary support on the way down, assuming of course we do get that close below $1,300. So I think gold is going to be one to closely watch in the coming days and weeks. Again, the UK 100, again we've seen another notable move today. We are seeing some strong moves in the FTSE on the back of the weakness in the pound. I believe it's around 85% of company profits in the FTSE 100 are generated from abroad, so any weakness in the pound is actually beneficial for these companies listed in the UK and on the FTSE 100. You can see that we're actually trying to break through the all-time high in the FTSE 100, so we are now at a very critical zone for the FTSE. This is the high that we actually hit earlier last year, around let's look at that level, 71.23. We've come within touching distance of this before actually failing at the high. Now we haven't seen a big pullback as of yet, so that suggests that this is going to remain under pressure, but if we do see a pullback to the downside, then we could be looking around the 60,900 level. You can see a number of levels of support here from the most recent high, or if you zoom out a little further, you can see that this little region here, let me just take this back out for you again. You can see that if we zoom out here, you can see that the region around 69.15 to 68.80 has been previously quite a key level of resistance, and therefore may offer a little bit of support if we do see a bit of a broader pullback. We've also got, of course, the descending trend line. You can see on the daily chart here, we've got the descending trend line from these 24th of June lows, which also may offer some support if we do see a bit of a correction back to that level. But it is looking very bullish for the FTSE, which does coincide with the fact that it's looking very bearish in the pound. Also want to keep an eye on, I think, is the dollar yen. We're seeing some upward pressure on the dollar yen once again, and we're seeing that Ichimoku cloud being tested, which has provided resistance throughout this move down. We've got the moving average band, the 55 and 89 moving average band again, which also falls within that Ichimoku cloud. If we see a breakthrough these 103s at 103 to 103.50, I think we could potentially see quite a that could be quite a substantial bullish breakout. So that's another chart I really think it's worth keeping an eye on. I think things are starting to look a lot up now. We've seen periods throughout the summer where we've seen where we have seen lower trading volumes, we have seen lower volatility, but I think we're looking at a number of things now: oil, gold, the FTSE, euro, dollar, cable, dollar yen, among many others, and they are looking a lot more volatile now, which should be very interesting to all traders out there. For more in-depth news and analysis, check out OANDA Market Pulse at marketpulse.com. You can also find out more about OANDA and sign up for a free demo account at oanda.com. Here you'll also get access to OANDA Forex Labs, which has a lot of great tools designed to help you with your trading.